Good morning, ladies and gentlemen. Welcome to the Flow Show. Here we are, Wednesday, the 14th of August, and surprise rate cuts coming from the RBNZ. Well, sort of a surprise, depends who you've been reading. Just before we get stuck into things, as you can see there, we've got our trader coaching program. If you weren't aware, where you can basically get in contact with any one of the ForexAnalytix team participating in the mentorship program and have a one-on-one session. Don't forget there is 40% off your first hourly session. So if you haven't used the coaching sessions before, you can get 40% off your first session. That's with each coach. And then there are other packages if you take more than one session as well. So have a look at that. We've been getting quite busy of late on the old coaching front. Lots of people who just want to take that extra time, get that information they need to help them trade a bit more. So if you want to do that, check it out, trader-coach.com. Right, let's get stuck into it. Lots going on in Japan. PM Kishida dropping a little bit of a bombshell, saying that he has no plans for re-election in the party leadership race in September. So as it stands, he'll be stepping down in September. Now, it's a political bombshell for us over here. It's not so much a bombshell for those in Japan. His premiership has been a bit tainted since he took over from Abe. Due to various scandals going on within the party. So he is deciding in the usual Japanese way to, fall on his political sword, shall we say. And so he's going to be standing down. He hasn't exactly had great ratings from the population since he's been in charge. So for the good of the party, he's stepping down, and so we will get a new leader in September. It doesn't really change anything on the political landscape because the LDP and all their cronies are the biggest party, and there's no signs of changing that anytime soon. So Kishida is off, and we'll get to see who comes in. Some in the market drawing the conclusion that him going means the BOJ can continue hiking. I think that's a load of old bollocks. The BOJ will do what the BOJ need to do, irrespective of who's in the leader of the government is. So people in the press doing the usual, just trying to make up a headline to get the market moving, but I wouldn't be listening to those. Right, over at the RBNZ, they cut their rates by 25 pips, which some, again, are calling a surprise. We've been talking about the disparity between analyst expectations. These are the guys who put forward their expectations that appear on the calendars. So the wires like Bloomberg and Reuters go around all the banks and institutions asking the economists and analysts what their thoughts are. Then they get a median projection of that. So the median projection was that rates would stay unchanged. Instead, they cut them by 25 basis points. That was more in line with market pricing, which showed us, 75, 80% chance that a cut was expected. So the market prices got it right, the economists got it wrong. No shock there. Now, they said that inflation is returning to their target band and that further easing will be conditional on the committee's confidence that pricing behaviour is continuing to adapt to a low inflation environment. They had some comments about the weaker economy as well. And as regarding future rates, and they have their forecasts, shall we say, for rates. They now see the official cash rate at 4.92% in December this year. That's down from 5.65% previously. So if you take it that we're now at 5.25%, that's roughly another 25 pip cut by the time we get to December or in December. For 2025, December 2025, they now see rates at 3.85% versus 5.14%. So quite a significant drop in rate expectations there, or in their forecast rather. RBNZ Governor Orr said we can start the renormalisation of interest rates, but said that the darkest period for the economy is right now. Now, what was a bit of a dovish line from this was him saying that they considered cutting 50 basis points today, although the consensus was at 25 basis points. Not sure how we should take that. The market hasn't really taken that to heart. You know, it's one of these things, everything's on the table sort of things, but I think a 50 pip cut is a bit too extreme. But as he says, it's a dark period for the economy right now, so that may be on the table. It may just be something they're using as a bit of a stick to get financial conditions easing that much quicker. You remember the financial conditions calculations or conundrum that they have, where central banks talk dovishly or hawkishly, and the market does the pricing for them, or the easing and the tightening for them. So I will put that down, that comment, that 50 basis point comment down, as a bit of verbal easing, shall we say, getting the market moving that way, making the economy easier. Anyway, so we've seen the Kiwi moving south. I'll go into that in more detail when we look at prices in a bit. Right, coming over to data for today, we've had UK CPI data, and it's a little bit mixed. It's inflation, headline inflation was expected to go up from 2% to 2.3. It only went up to 2.2, so the market got its higher inflation number. The core, though, that came down more than expected. Came down to 3.3% from 3.5%. So the core is probably the more important one in terms of the Bank of England. That's still slowly coming down. So it keeps the BOE in cut mode most certainly, but they're not in a rush. They expect CPI to pick up as well, so it doesn't really change the picture that much, although obviously we've seen some rate pricing changes, which I'll talk about in a moment. Some of the other data, PPI, so output prices came in up, but less than expected. Input prices for the year came in up a bit too. There was a higher revision last month, though we saw a little negative on the monthly and a flat number on the output monthly as well. So a little bit mixed there. Not really giving any clues. Maybe a bit of a shocker. RPI prices, this is retail price index, so shops and whatnot, seeing a bit of a pickup there, 3.6% from 3.4. So that puts a little bit of stickiness into those numbers. But overall, for me, it doesn't really change anything. The market has, though, fully priced in 2 more cuts for the rest of this year. And we're now seeing a 47% chance of a 25 pip cut in September. That's up from 36%. So there's been a little bit of a movement in rate expectations there. Over in, we had Swedish CPI as well, coming in softer than expected, though unchanged over last month. So the Riksbank still looking at potential cuts in the latter half of this year. So is that enough for them? We shall wait and see. We saw one of their other measures, their core measures, coming down a little bit as well. So creeping closer to target. Another one they use here, constant interest rate, CPI-F. That was a little bit hotter. So maybe they will keep those rate cuts on the table rather than putting them forward into policy just yet. Eurozone GDP coming out as well. This was just a revised number there, coming in unchanged over the flash number that we saw previously. France CPI as well coming in a little bit hotter. HICP 2.7%. CPI also coming in higher than last month, 2.3%. So again, just seeing some Eurozone countries just seeing inflation coming down and then just ticking back up again. It's all part of this bumpy ride. The first part of US inflation data was out yesterday. And core PPI came in softer than expected. 2.4% was expected to drop to 2.7. So quite a big drop in that. But as I've mentioned prior to this data, and I mentioned yesterday here and on F.A.C.E, the PPI can be a bit more volatile, and it does. Some say it leads PPI, leads CPI. It does. There's a bit of a lag between the two. So headline PPI also coming in softer than expected, 2.2% versus 2.7. So if anything, that keeps a September cut on the table from the Fed. There's no reason for them to change their mind. This probably just a little bit helps them on their way if they are going to cut in September. PPI probably lags CPI by maybe 3, 4, 5 months. This is sort of the sharp end of the inflation, at least from a manufacturing perspective. So there will be some feed through. As long as this is trending lower, then they should see the same in CPI. But obviously, CPI is made up of many other things rather than just a producer front, food and energy and the likes. Looking at rate cut expectations for the Fed, and I'll look once again at CME Fed Watch. Anyone can look at this, so it's a free tool if you want to keep an eye on what's going on with the Fed. You can look at the various meeting months to see what the expectations are of where rates will be. Okay, so where rates will be at that meeting. So for September, we're pretty well, it's just edging now. It was pretty much 50-50 when I looked earlier, that it was between a 50 pip cut and a 25 pip cut. This did get up to 54%. This is based on futures, okay? So it's slightly different pricing to some of the other areas that people watch at, like interest rate futures and overnight index swap prices, OIS as it's called, where you can get different numbers. But if you just want a rough guide of what the market's looking at, then this CME Fed Watch tool is pretty handy. So as I say, give or take, pretty much 50-50 between a 25 and a 50. I still think a 50 is pie in the sky, but you never know with these clowns. We had Fed's Bostic out as well yesterday. He said the balance of risks in the US economy is getting back to level. It says the Fed's rate posture is restrictive. The rate posture is not where the Fed wants it to be forever. Recent inflation data gives him more confidence that we can get back to 2%, but wants to see a little more data. It says we need to make sure the inflation trend is real. So a cautionary note there. Would be really bad if we cut rates and then had to raise them again. I think there's a little chance of that happening, but you never say never in this game. It says he's willing to wait for the first rate cut, but it is coming. If the economy evolves as he expects, there would be a rate cut by the end of 2024. It says housing inflation has come down in an important way during the last couple of months. And another central banker talking about his district and what's happening in the jobs market. He says that contacts don't tell me there are many layoffs. If that continues, we'll be in a good place. So I think he's the third central banker to speak to businesses in his district and asking about the jobs picture, and saying that there's no one laying off, but it's just really seeing a slowing in hiring. Obviously, slowing in hiring is the first step before you get layoffs, but we're not in that phase yet. We're in the slowdown phase, it seems, in the jobs market. So that's an indicator that probably for the next couple of NFPs, we might be seeing some softer numbers. It'll be a big deal if we start seeing some negative numbers, but softer growth numbers is one thing. That's it for that on the headline front. Not much going on. Obviously, US CPI today is the big data point. We'll have a quick look at that. CPI, headline CPI, it's expected unchanged, excuse me, at 3%. The core is expected to come down a pip to 3.2%. So really, we're going to need to watch obviously what happens here. It's going to be a psychological thing if we see CPI with a 2 handle on. I've been pointing this out for, well, forever. If we look at it, we haven't been below 3% for well over a year now. So psychologically, if we see a 2 handle on CPI, that's probably going to firm up the September cut and get the market then jiggling around how many cuts it thinks is going to come for the rest of the year. So that's good. The first thing to look at, that headline number. If we get a 2 handle, 2.9, 2.8, that's probably going to get the market moving. The core as well, it should move slower. So anything more than sort of a 2 pip variation will be more volatile for the market. Again, maybe if this sees a 2 handle, when we get both on a 2 handle, then we're going to see the dollar getting sold again. Probably some of those pairs, euro dollar, cable kicking higher, another leg again. So you balance of risks. Now, if the CPI does come in hotter, if we see an increase, say 3.1, 3.2, 3.3 on the headline, maybe this staying unchanged or ticking up a bit, then we're going to see the dollar gaining some and those rate expectations washing out a bit. I don't think that will change the Fed's view about cutting rates, in my opinion. Powell may use Jackson's Hole to give a little update, though, so be wary of that. It's not 100% done deal that they cut rates in September. So if it is hotter, then the market is going to, as usual, reprice things. I think any dollar rally, as we've seen time and time again, is there to be sold. Unless inflation does start properly trending higher, it's just going to mean higher for longer and a more bumpy road before rates start coming down. So we could get a phase of dollar buying if it's hot numbers. How long that lasts, I don't know, but I think it will reverse at some point. So that's what I'm looking at trading wise today, to maybe hit a dollar rally if it becomes really choosy. That's it from the data on the US front. Just having a quick look through, making sure I've not missed anything. No, that's it. Just also keep an eye on the earnings numbers as well. They come out with this CPI data. I think we get the hourlies and some yearlies. Let me just check on my calendar. 1 second. Yeah, we get real average hourly earnings and real average weekly earnings as well. So just keep an eye on those. If we get some soft numbers there, we could add or subtract from the CPI data. Right, let's have a look at what's going on. We're going to start over in Kiwi land. So we've had this move south. We got up to the top of this, one of my zones, support and resistance zones between 60s, sort of 60s, 90s, 80s. One of those areas where we seem to have a lot of stuff going on. So that's where we were topping out into the RBNZ. We've obviously seen a significant drop after. We are holding around the big figure, the 60 level. Let's just come into a small area there. So it's a bit of an area again. 60 big figure, 59.90, 59.80. A couple of guys, I know DKT in our room is penciled in at the 59.80 level, so probably a little bit of a zone down here as well. We're holding above the big figure, so it looks like for now the market is done with this. We'll have to wait and see what comes from the CPI. So a hot CPI, we're probably going to flush a bit lower. I'm already long a little bit at 60.10, very small long, just trying to support down here. And if we get a snapback over the CPI data, but if not, if we do get a bit of a flush out, I'll probably look to add to that position as well, depending on where we go to. So yeah, as I mentioned, I'm feeling a bit rally selling in the dollar. That's my mood at the moment. Another one I'm looking at is Aussie Kiwi, because I'm getting to the point where I'm going to start calling bullshit on the RBA. They're one of the biggest clowns, central banks there are. These guys, way back when inflation was taking off, they weren't going to raise rates until 2024. And here they are, rates up and still talking hawkish. while CPI is dropping around the globe. So I think they're talking at their arse. I fluffed a short last time in this move up. I was shorting it up here, up into the 111s. I had my stop at 111.30, and that got nicked out 25 pips higher than my stop before coming back. So I'm thinking of having another go, but I'm going to be picky and see if we get a move up to back up to this area up here, high 110s, 111s. Because as I say, I'm feeling like I want to fight the RBA and their call that they're going to maybe have to hike again. I can't see it. Never know with these guys, but I just can't see it given the global picture. So I'll be looking at that. Obviously, this is up again on the back of the RBNZ. So yeah, that's one I'm keeping an eye on. My mate Himashu says, what is your company choice to fade the dollar rally? I think I said yesterday cable would have been a good one over the PPI data. It's proved to be a fairly good one over the UK CPI data that's come into a time frame there. Soft CPI, we saw a move down, couldn't quite get down to the 128.10 break point that we had yesterday. You can see we tried a couple of times, then we started holding 128, then we broke 128.10. Now we're starting to hold 128.10. So we couldn't quite get down there on this move, but we've gone up pretty quickly after the CPI data. So this, again, it shows you get a move. The dollar side of things is more important. The market putting this right back on the weaker dollar picture. So that's typical of what I'm looking for in selling a rally in dollars. So again, cable, it's proved it this morning. Another move like that down towards 128 will look very tempting, depending on the numbers, of course. So Himashu, that would probably be my go-to, even though I'm looking at Kiwi dollar as part of another trade. If I wasn't doing that one, I may still look at it as well. Can't look at too many pairs over one data point. But cable would potentially be my ideal one if you wanted to fade a dollar rally. Dollar yen in general hasn't really moved on the Kishida stuff. We're still stuck in this fairly tight range. Still lots of volatility. It's not afraid to dip under, to move down, as we saw overnight. Again, this is the Kishida news. So we got a little bit of a move through this 146.50, but it hasn't lasted. We've bounced back above. We bounced back above 147. So the market's had a little flip out there, but it just, again, it shows you the dips are being bought pretty strongly. So while we can't hold below this 146.50, it does keep, let's call it, the recovery of these lows in play, although we are going a little bit sideways at the moment. I'd be less inclined to trade this one over the CPI data, just because we've still got that high volatility and they're still sailing above 13% in the 1 month at the money. So, you can lean on levels, but you've got to be prepared that if you're going to move, it's going to be, 50, 60, 70, 80 pips, not a 10, 15 pip move on a headline like you might get in euro dollar. So the volatility is really still keeping me out of this one. Let's have a look at what else is going on. We've still got this risk issue hanging over us in terms of Iran, Israel, whatnot going on. There's been a few little bits and bobs going on, but nothing major as yet. Nothing that the market's really taking notice of anyway. A few people are wondering why we've topped out here and why we've seen a bit of a steep pullback. It's probably just market positioning. Okay, we've got two things at play in this one. You've obviously got the weaker demand picture, higher production picture. So the fundamentals are the reason why oil won't climb higher. We've had this risk move on the back of this. It's either people who are short getting out of shorts, okay, because they don't want to be short going into a risk event. But there's also probably some people who are long, getting long. So if they catch a pop, if they catch a headline, they'll get a nice bump up. But they're only going to buy it so much, and only going to buy so far. So I think what we're seeing now is just the market has priced all it needs to price. The ones who didn't want to be short have got out. The ones who are long enough. And now we're just going to be treading water until we either get a headline or things dissipate and calm down a bit. If that happens, I expect the downtrend to resume, and we'll probably undo a lot of this because all the longs will get out. They'll exit out, and anyone who got out of shorts will put their shorts back on again. Failing that, if we do get a headline, we have to see the severity of it. We get the pop, and then everyone who's long gets out, and everyone who's short starts playing again, and you're still going to move back down. So we're still in the same boat, but now I think the market's probably well balanced in terms of its risk pricing, hence why we're not really moving higher much at all. Looking at some of the others, gold, that's still hanging around up near the highs. Again, I'm not too keen on shorting this with a risk headline. It looks like the market's waiting. It's waiting. So it looks like there's people who are long, who are just waiting for this headline to hit, get a pop, and then they'll all pile into it. Because we have seen these moves happen where it's a quick move up and then gets whacked pretty quickly. So if you are long gold, if you are holding on and waiting for this headline, if you see that headline, you've got to think about hitting it and taking, a good chunk of your profit off in case you just get a spike move that everyone's waiting to knock on the head. Obviously, you have to decide the headline itself. Is it severe? Is it not? And then take your cue from that. But I can see exactly the same happening here. If it's a bit of a for show headline from Iran, lobbing loads of stuff over but not really doing any damage, we'll get the spike and then it will come down again pretty quickly after. That's how I'm looking to trade it anyway. If I can catch it quick enough, decide on the headline. Is it good? Is it, well, not is it good? Is it bad, or is it really bad? And then react accordingly. While we're looking at oil, might as well take a quick look at dollar CAD, because that's again, as I've been talking about this week, we've seen oil coming off a little bit and now CAD strengthening. So this is the dollar side of dollar CAD taking over. This is following the dollar weakness that we've seen from yesterday. So that's why this move is down, because if it was following oil, then obviously this would be going up as CAD weakens on the weaker oil price. So this is off the oil bus at the moment. There is a bit of a level here, obviously around the big figure, as there often tends to be. Got a smaller level under here, 136.80. We're probably in range. We're probably well in range now. If we get a really soft CPI number, we could be heading down 136.50, 136 again, bringing us down to the bottom edge of this range. It's been a solid area to trade, so this may be somewhere I look to just play the text rather than fighting against dollar weakness. It could be that we may see a break. I don't know. I didn't trade it last time. I'm still running some sell stops below this level. Talking about sell stops yesterday with our mate Very Nutty. I am running some sell stops still below this area because I think if it does go, it's going to have some legs. But a level's a level until it's not. So if we get down here on the CPI, I'll consider that a bit of a stretch point where the market may pause. And so I might try longs down there, keep them very tight and look to reverse it to a short. Euro dollar, that's motoring now well into the 110. We took out the recent highs, just had a little poke above beginning of August when we had that flip out last week. We're now back above, pushing up towards 110.5, 110.45. Again, just a little bit of an on-off level, seen a bit of action. Not exactly one I'd trade for entry, but if you're long, it might be somewhere you want to think about, again, about taking a little bit of profit. Obviously, 111, the big number, 111.5 above the main resistance up there. Just coming out a little wider because there are, if we start getting up there, there are some bigger levels above. 112 is a pretty decent area as well. We start getting into some real historical stuff. Let's see, it's better on my cleaner charts. There we go. So you can see the 112, It's had some real big moves around it. Then we get up to 114.5, 115. Okay, these are now getting into some really huge levels. These are, you know, big multi-year levels that have had a lot of action going back. So, you know me, always the exercise, look at your wider charts, look at your cleaner charts, just see where the bigger levels are coming up. We've got plenty of strong levels in between, but there are also some real big doozies that are coming into the mix if we continue this move higher. But going back to the shorter term, let's go back into here. Oh, a bit wider. 4 hourly, that will do. So yeah, this could mean we're just busting out this range that we're seeing at the moment. Okay, it's not out the woods yet. We've still got some high levels, but just over, well, this year particularly, we've had this run, you know, down into 106s, 107s. We've been knocking our heads in the 109s, just below 110s. We're now potentially breaking out of this. So it could mean a run further. Mr. Michael Brown at Pepperstone is quaking in his boots because we've got another little lunch bet on. He thought we'd see 105 first. I thought we'd see 111 first. I think I even gave him a head start on that one. And so, yeah, there'll be another lunch if we trade 111. I'm looking forward to that. I'll take him somewhere really expensive. Aside from that, not much else. Aussie dollar pretty much doing the same thing. Again, just running into another zone up here, 66.40.50. One of those levels again, point. You know, when you've been away and come back, it tends to have a say in things, you know, then sometimes it gets a bit wishy-washy. But here we are, 66.45.50. Can't get through that at the moment. Aussie dollar again might be another one. If you believe the RBA, if the market certainly believes the RBA, you get a decent dip in this one. Again, it might be one that sees a decent reversal if dollar rally selling is going to step in from the market. So there's plenty of these pairs in Mashu to pick if you want to fade the dollar, but you know, just make sure you assess that data as it comes out. Right, anything else, people? Not much else to look at. Always keep an eye on yields as well. Let's have a quick look down there over the data, just see what's going on. Still looking a bit soft again in 10 years. Bit of a move, more move in the short end than we're seeing in the longer end, or rather the middle. This is where we're really going to be the 2 years. A good rule of thumb to see where we're mooching around rate cut expectations. Still with the market pricing somewhat a 50 pip cut from the Fed in September, probably seeing this a little bit too soft. So it has the opportunity maybe to see yields rally, but again, if we see yields rally, I don't think that's going to last. I said it about 10s. I could see us, you know, maybe getting back into 4%. 420 would be a stretch. You definitely look to probably be a buyer in bonds if we got to there. But we can't get above 4%, and now we need to look towards this spike low that we got last week. That's where the market went. Enough's enough down there, but we're creeping down there at the moment. So let bonds be thy guide, as always, for where the rest wants to follow. Stocks quickly, S&Ps. Let's just zoom in a bit. Okay, haven't really had a test of this 54 level. We've sort of had, you know, I wouldn't even call it a test. We've had a break. We haven't had a retest. So that hasn't yet given you proper confirmation of the break. If we get over this data, if we see a retested level and it holds, if you weren't long already, that's the sort of signal you want to be looking for to maybe get long. Obviously, we've got this bigger, much bigger 54.5 level up here. So that this was the first, or this down here was the first litmus test. 53.30s, 53.90, 54 was the second litmus test. This is going to be the doozy. This is going to be the big one. If we get above there, then I think there's every chance we go on and at least have a look at these highs. because this is be a really strong move on that. But as I say, you know your levels where your risk can be placed. If you want to short, then you've got to be thinking about this area. If you want a long, you've got to be thinking about a test and hold of that 54 there as well. Your money's on me. Monsieur, thank you very much, mate. We shall see. You know, the only thing I'll do is protect my risk. If I'm wrong, I'm going to be wrong on my terms, and I'm not going to be a deer in the headlights. Right, I think we'll call that a day. You will have the smart company of Stellius tomorrow because I'm off for another little break for a few days. So I'm heading out. So Stellius will be coming in and keeping you guys entertained. Please remember, as I said yesterday, have loads of questions for him. Get them all lined up. You know, if you want to know what's happening in the Brazilian Real Polish Zloty cross, ask him tomorrow and make sure you keep him on his toes. He thinks he's going to come in, do a couple of charts and do a nice quick one. So I want you to make sure you get your money's worth. Anyway, have a good one, everybody. Stay safe over the CPI data today. I will see you in a few days and we'll be back to normal sort of Monday, Tuesday next week. K-Man will be back as well. Have a good one. If I don't see you, take care. See you on Face later anyway.